Multifamily properties. I think it's the best asset class to invest in. When I formed the company Infinity Investments in 2009, I left my old brokerage. I was working for Sotheby's. Sotheby's is primarily a residential brokerage, high-end residential, Oakland Hills. I was the only guy selling apartment buildings at the time. So it was, for me, I just sold a big apartment building. It was time to move on. And what I noticed, that was 2009. If anybody was doing real estate deals in 2009, remember how crazy it was? It was a little bit, it was the Wild West. A lot of people had just lost a lot of money. And what I realized is some of the people who were around with big pockets and making moves and buying up everything at that time, in 2009, were people who owned apartment buildings. And I had a client in particular, he sold all his buildings in 2007. He was wise. And then in 2009, he came back and started paying cash for stuff and buying up stuff. So I saw that and I said, well, look, I want to swing the bat, start a company. And I wanted to do it around the idea of brokeraging and investing into multifamily buildings. And the reason why, primarily.
So that's a scenario where people actually sold their properties at the height of the market without doing 1031 exchange.
Absolutely.
Cash and paid all taxes.
That's my client did that because he had been through it. The only reason he decided to sell his stuff, Ron made a good point. You do a 1031 not to defer your taxes because you want to buy something better. Well, at that time, he couldn't buy anything. And this is a guy with a lot of cash. And he couldn't buy nothing because everybody was overbidding and nothing made sense. And he saw kind of what was going on with some of the financial products. And he said, hey, I've seen this in the 80s before. I think the market's going to crash. Time for me to get out. So he paid taxes. Now, he did that because he had foresight. He thought the market was going to crash. Now, if the market didn't crash, he would have paid a lot of money in taxes. But, the market crashed, right? He got it right. I told him he needed to write a book. Let me help him out with that. But that's what he did. And then he came in 2009 and started buying up everything. You know what I mean? It was timing. It was smart. And his vehicle was multifamily. And what I saw in that period of time was a lot of vacant office buildings, a lot of even vacant houses. Remember when all the houses were getting foreclosed upon? And you go in Oakland, you're driving through Oakland, and half a block is vacant. I remember I had family out in Stockton. We were out there, the whole block was vacant in Stockton, right? So you see all these vacancies. When I looked at apartment buildings, vacancies came down a little bit, right? But the occupancy rate was still higher than pretty much any other occupancy, any other asset class, because people still need to live. When they get foreclosed, you lose your job, we all got to live somewhere. So that's what apartment buildings offer us, is a shield against some of the economic and market pressures. When things go bad, things go good and things go bad. It's cycles. It just happens, right? And things went really bad, but apartment buildings still performed better than the other asset classes. So that's why I chose to focus in on apartment buildings and have that be the core of what we're doing. Now, in the good times like today, apartments still winning. Everybody wants apartments because now a lot of the units, they're full. In East Oakland, I do a lot of work in East Oakland, West Oakland. I'm breaking into West Oakland, but I'm from East Oakland, so I got a lot of roots there. It's easier for me to do deals there. In some of the tougher neighborhoods, buildings are still full, and rents are going out of control right now. So it just is. It's a good product type. I mean, there's a whole bunch of different properties, triple net lease property, that's commercial, office buildings, hotels, single family homes. There's a lot of different products you can invest in. I think multifamily is the best, and so that's why I focus on it. But whatever you do, whether it's multifamily, office, retail, single family, whatever, you want to do it on some basic fundamentals. When you're investing, you're taking risk, and you want to try to modify that risk, minimize it. You want to try to control it as best you can. At the end of the day, you're taking some risk. So, and you're not always going to be right, but you want to give yourself the best chance for success. Therefore, you want to make sure you're analyzing what you're buying. Don't just go in, oh, real estate, it goes up. Remember those days? Sometimes it goes down too, right? And there's risk involved. Usually the biggest risk is the debt risk. When you go and buy a property, you'll get a mortgage. There's some risk associated with that. There's other risks as well. That's the number one risk, is the debt risk. It's not a good or bad thing. It is what it is. You just got to be aware what that debt means to you. Now, you want to analyze your income. All right. When I go into my presentation, I go kind of detailed by detail how to analyze a property to figure out if this property is going to be a good deal or not. You don't know what's going to happen in the future, but you can analyze the past, right? So when you're looking at an investment property, whether it's a house, duplex, 100-unit, whatever, you want to look at the income first. And you want to look at the gross income, what is brought in by the building through the rents. Bigger buildings have other categories like vending, laundry, other things that you can generate income from. Most of the money is going to come from the rents, right? You want to look at the vacancy factor. Okay, when you are looking at apartment building, you're going to look at something called a rent roll. A rent roll is going to tell you which tenant lives in which unit, how much they're paying, what their deposit was, when they moved in, when the lease ends, etc. Right? You want to analyze that because that tells you what your gross rents are scheduled to be, and then you want to compare that with the market vacancy rate. All right, every market's going to be a little bit different. Within a city, it's going to be a little bit different. In Oakland, just to give you an example, from East Oakland, like deep East Oakland past Seminary, that's going to be a little bit different than the Fruitvale district, which is going to be a little bit different than Adams Point, which is going to be a little bit different than West Oakland. All of our vacancy rates are under 3 and 4% right now. It doesn't matter if even in deep East Oakland, the vacancy is less than 3%. All right, so but just know in neighborhood to city, it's going to vary a little bit. You want to know what the market vacancy is. You can go to a couple different websites. MarcusandMillichap.com. They produce quarterly reports on every major MSA in the United States. Also, I believe they do Toronto and Vancouver and a couple other Canadian markets. So and a lot of the stuff is for free. You got to sign up on their website and everything, but you can get the report for free. That'll tell you what the market vacancy is up to the most recent quarter. So like if you went there now, I think it would tell you what the second quarter numbers. I don't think we have our third. Well, obviously we don't have our third quarter numbers because the third quarter is still happening. So you would see what things happen from April to June, right? So if you went to MarcusandMillichap.com, also Hendricks Berkadia, now it's called Berkadia.com. Used to be Hendricks and Partners. They're also a big apartment brokerage. If you go on their website, which now is Berkadia, which is owned by Warren Buffett, but you go to Berkadia.com, they have market reports for each market, so you can know what the market vacancy rate is. Look at your rent roll, apply the market vacancy rate, whatever the seller had going on, either good or bad. You want to know about it. If there's a lot of vacancy, that's usually an area for concern. So understand what that is. That also is an area of opportunity, guys, because if the market is at 3% and these property owners are at 10% or 15%, that means they're doing something wrong, or something wrong with the building, or both. That's an opportunity for you if you manage it right, right? But just know what the market is, know what the building is, because when you take the vacancy away from the rents, that gives you your effective gross income. That's the money you actually bring in. That's important because that's the money you pay your operating expenses with. Now, in my presentation, I'll go line item by line item. I won't do that now, but just know this. An operating expense is what it costs you to operate the building. This is important because it's not factoring in the debt. All right, debt is the cost of the money. Right? If you paid cash for the building, you're still gonna have property taxes. You're still gonna have maintenance, insurance, and pests, and sometimes security. You're gonna have what we call operating expenses, the cost to run the building. All right, so you want to look when you're doing your analysis. You want to know what the seller was paying for the last 2 years, maybe even 3 years, and in the existing year that you're in right now. Analyze it, analyze it, analyze it. Look for opportunities to reduce it, but don't just think that overnight you're going to come in and the PG&E bill is going to drop 50% because you got in there, right? You know, don't work that way. Now, maybe there's an opportunity to building's master meter. Maybe you can roll or implement an individual metering program to reduce the cost. Maybe, but just know what the expenses are. Know what you maybe can reduce. What maybe might go up. Hey, if somebody bought the property in 1952 and they're paying X amount in property taxes, you probably gonna be paying a little bit more money in property taxes when you buy it. In California, property taxes are based off of what the purchase price is. So just be aware of what the past is, have an understanding of what the future is. When you take your effective gross income, you take away all your operating expenses, that gets you the net operating income. That's the lifeblood of the business. That's what the property is worth. There's something called a capitalization rate. I won't go into that now because I'm not in the presentation. Give me a call, give me your email, I'll send you out the presentation. But just know this, the net operating income directly affects the value of the property. More income, higher the value. Appraisers will use something called a capitalization rate to get to the end value. They take that net operating income, they divide it by what's called a capitalization rate, and they get to your end value. All right, just know this: more NOI, the better. Right. So when you buy it, you want to know what that net operating income is. It's called NOI, and then you want to see how can you increase it while you own it. Don't just wait on the market rents to go up. Look at, hey, can I raise rents here? Can I cut expenses here? That way you can force their value to go up by your efforts. If you can time a market, that's great. I talked about my client who sold everything in '07. He'd been doing this for 30 years and at a high level. So he sensed it, right? There's a lot of people who do it for 30 years who lost everything, right? So sometimes knowing the market, not knowing it, that's a skill set. Maybe you have it, maybe you don't. But what you can do is you can't affect the market, but you can influence your own property. You can increase the income, you can reduce the expenses, because that is how you affect the value of the property. And understand this: your net operating income is what you use to pay your mortgage with, right? So the net operating income is before you pay your mortgage, right? A lot of us think, hey, as long as the property pays for itself, that's a good thing. But what happens if you have a bad month and the property can't pay for itself that month? You need to make sure your net operating income is a little bit higher than your mortgage payment. Your annual mortgage payments, where you take your mortgage payments times it by 12, that's called your annual debt service, right? You need to be, banks want to see you be about 1.2%. What that is if, let's say, your NOI, your net operating income is 120,000, you don't want your mortgage payments totaling for the year to be more than about 100,000. That way you have built-in cash flow. I had a property manager in Ohio, of all places, tell me we're working on a deal, and we were questioning him, why are we not making money here? We're looking at these, it doesn't add up. And he said, well, you don't buy property for income, you buy it for the long-term growth. And I said, not in Ohio. That's exactly what I said. But I said, look, when we bought the property, it was making income. The reason we bought the property is because we want the income, right? We are looking to receive income on a monthly and quarterly basis. If it goes up in value, fantastic, right? You want to buy for cash flow. In order to get cash flow, your NOI has to be higher than your annual debt service. And a good ratio is 1.2, okay, and above. The bank if you're going to get a loan, you're probably going to have that. But you want to have at least that. So you put money in your pocket. Don't just do this just to pay for itself. Now, if you're in that situation now and you're in it now, deal with it as best you can. But if you're going to the next one, you want to make sure you're putting something in your pockets. Because of the risk you're taking, you need to have a reward for it, okay? So you want to make sure that your income is enough to pay your expenses, your net operating income is enough to pay your mortgage, and that you got something left over. This is the ABCs, but you'd be so surprised how a lot of us miss that from time to time, right? You look at a property, it looks really great, it's in a great neighborhood, you love it, you drive by it, everybody loves it, but maybe the numbers just don't make sense. So that's where discipline comes in. That's why I always talk about it every time I talk, because if we miss this part, we're leaving ourselves, our portfolio, our property, we're leaving it to chance. And you don't want to do that when you have maybe a $500,000 or $1 million mortgage that you're responsible if the market goes bad, right? We seen the blood on the streets. Let's not forget that. Let's be mindful. Don't let it scare you. But let's be mindful of it and move on and make sure that when we're buying property, that it cash flows, or it has the opportunity to cash flow once we get in there and do what we have to do. Critical, critical, critical. So that's what I want to talk to you guys about in terms of analyzing and evaluating property. There's more on this subject. The most experienced investors are always looking at how they can better break down the deal or better understand the deal. And my client who I was just telling you about, he's got 500 units between Oakland and San Francisco. He's always looking at the numbers. He's always looking at how he can improve himself. And you should be doing the same. We all should be doing the same. And everything's not going to be perfect in real estate. You're not going to make $2,000 a month on each property. It might be $1,500 this month. It might be $1,000 this month. It might be nothing next month. It might be $3,000 next month. But just make sure you're positive, that your property is not just paying for itself, but it's paying you, and you have a way to increase the income. If you can't do it with increasing the rents, find a way to decrease the expenses. All right. So that's on property analysis. I'm gonna wrap it up talking about finding deals, and I'm gonna mention a couple properties to you guys. Okay. Anybody made any offers on real estate in the last month or this year? Anybody made any offers? Raise your hand. Oh, a couple offers? We gotta get out there. We gotta make some more offers, y'all. Come on now. Okay. Anybody experienced overbidding, multiple offers? You can't find a property that makes any sense? Realtors? Right? In 2009, 2010, it was like kid in a candy store. You had money, you go out here and buy whatever you wanted to, right? In the Bay Area. That would make income. There was houses under 100,000. Y'all remember that? Yeah. Not anymore. Well, maybe, I don't know. Maybe you find something I don't know about, but not too much of that. So now you can't just go on the MLS. I mean, you can. MLS for residential, LoopNet for commercial, CoStar. You got to be a little creative. You got to think outside the box. And this is our constant struggle. It's our constant battle. This is where, as realtors and investors, we really may earn our keep, finding a deal. So the first thing I would say, I want to advocate for realtors for a couple different reasons. Because realtors in the business, before we list a property and put it on the market, we have something we call a listing agreement. The seller's going to sign the listing agreement with us. In order for us to get that listing agreement, we've had to prospect, we had to do something to find that deal. So realtors are always prospecting deals. And we always know what we have before it goes on the market because we had to track it down and put it on the market. So you want to have a couple good realtors in different markets. You want to try to get a realtor who specializes. If you're looking for a property in Sacramento, I'm not the guy for Sacramento. I might be able to directly use somebody in Sacramento, but try to use somebody who's specific to the area that you're wanting to invest in. And maybe you want to have a primary person you're dealing with, but you also want to be in the ear of a couple other realtors out there, because if they find an off-market deal, which is any property before it gets listed on the market, they'll tell you about it. And the realtor has a financial reason to do that because they want to what's called double in the deal. They make both sides of the commission if they find a buyer for the property. So we all want to do that. And if you're telling them, hey, this is what I'm looking for, this is where I'm looking for it, and they find that, they're going to give you a call before it goes to the MLS, all right? So that's one thing you want to do. Obviously, also, you want to use a realtor for a lot of different reasons in terms of the contract, so on and so forth. Now, outside of realtors, a couple different things. Obvious thing to do is to track foreclosures. There's a website called Foreclosure Radar. It's $49 a month. You sign up for it. You get notice of defaults, notice of trustee sales. It's really, if you're looking for a distressed property, looking for a deal, you kind of got to be on there. It's not the only thing to do, but you kind of got to be on there. If you want to find properties that are in distress before they get to the market, you got to know what's going on. You can send them mailers, you can knock on their door, etc. And you at least want to know what's up in your area, in your market. Foreclosure Radar is $49. I think it's called Property Radar right now. I think they changed the name. Now, the reason they changed the name is because, I don't know if you guys noticed this, there's not that many foreclosures anymore. You know, everybody was talking about this glut of property in this way. Well, you know, we start buying properties a few years and there's a lot of cash, and we looked up and, you know, I haven't seen an REO in a minute. I know they're out there somewhere. I just haven't seen one. Short sales also starting to dissipate. So there's not that many properties that are around. But you want to be aware of them when they do pop up, and you want to get to them before they get to the market. So Foreclosure Radar, another great resource. Okay, here's a couple things to think about that are kind of outside of the box. Bankruptcy, divorce, and estate. Now, let me just say this. Don't be an opportunist taking advantage of people's misfortune, right? So don't take advantage of people. Be aware of what's going on. People go into bankruptcy, usually it's because they have property they can't afford. There's other reasons, but usually a lot of times property they can't afford, or medical insurance or something like that. But a lot of times, if you go down to bankruptcy court, it's 13th and Clay, you start perusing some of the cases, you'll see properties that are involved in these cases. A lot of times, it's good to have a case number. It's good to know the property already. That's why if you're tracking Foreclosure Radar, if you see something in Foreclosure Radar, it'll say if it's in bankruptcy. If it's in bankruptcy, that's good because you can go down to the bankruptcy court, you can get the lawyer's information, you can get the lender's information. A lot of that's all public information. You might be able to get the seller's information. Now you can go direct and try to reach out and say, hey, I'm a buyer. I'd like to buy this property. They may not sell it to you at that time. You might have to wait a long period of time, but it's a great way to get deals. Bankruptcy. And then so But a good way to do it is to look up the bankruptcy attorneys in your area. You just Google bankruptcy attorneys. So maybe some top bankruptcy guys are going to pop up. Call them up. Hey, I'm looking for real estate. I'm looking to buy real estate in this area. See that you're a good bankruptcy attorney. Hey, if anything pops up your way, tell the what do they call them, the debtor, to give me a call. If they have an agent, tell their agent to give you a call. Properties, when they're in bankruptcy, have to be sold at some point. Not all of them, but most of them have to be sold, and you can get them at a good discount. So just be aware of that. They're a little bit, the bankruptcy process is very difficult, but I have not been working on a bankruptcy deal since 2010. Since 2010, I've either been in contract, in escrow, or working on a deal that's in bankruptcy. A lot of realtors don't even go this route. So if you're an investor out there pounding the pavement, it's a lot of footwork, but it's just another way to get it done. Divorce. First property I ever sold was my mom getting divorced, not from my dad, but from her fifth husband. And so I was happy to sell the property as a realtor. Now here's something I learned in that process. That was the first property I ever sold as a realtor. When we were going, I would go to the court and I put the property in the market. We listed it for too high. It wasn't selling, right? This is 2005. When we dropped the price, it wasn't because my mom or her husband wanted to drop the price. They wanted more. Because the divorce court said, y'all better sell this property. This is the last thing keeping us all in here. We're tired of this. Drop the price. And that was like music to my ears because they didn't want to listen to me to drop the price. They listened to the court though, and they dropped the price. And then lo and behold, next week, property got sold. So a factor of court influence is why that property had to be sold. Now again, if you have a friend that's going through divorce, you might not want to, hey, when y'all gonna sell that property? How's it, be aware of what's the people element. This is a people business, you guys. Nobody wants somebody, if they see you buzzing around trying to take advantage of the opportunity, they're probably not gonna sell to you anyway. If you're talking to somebody in this situation, be empathetic, be helpful to them. At some point, they're gonna have to sell a property anyway. And if you're their friend in need, if you're their shoulder to cry on, you'll probably be the first person they call when the time is right. But just be aware that these situations are out there. And the last one is estates. So you ever drive in your neighborhood or somebody else's neighborhood, you see a sign say estate sale? Y'all ever seen that? Usually because somebody passed away, unfortunately. Or somebody's going into a home or something like that, right? It sucks, but it happens. And you go to the house, there's all this stuff in the house. You know, they're selling dressers and drawers and 8-track systems. You know what I mean? But the house has to be sold, probably 9 times out of 10. So go to these things. And now, it may have been sold by then.
The house is in contract.
Because somebody's swooping around. But maybe not. Now, a lot of times these families are going to have realtors too. A lot of investor classes teach, don't use realtors, don't go to MLS. MLS is going to be, you still need to know what's going on in MLS. You still be aware of what's happening. But a lot of times realtors can be your best resource. Just because somebody's listing the property doesn't mean the property can't be a good deal. Realtors can be a great resource for you to find deals, not just go to MLS. And that you can, if you roll your sleeves up, you can find a deal out here. There's also other strategies like buying the note. If there's loans that are in default, you can buy the note at a discount. I would only suggest doing that for commercial or investment property, because if you do that on a single family house, the rules are different. But if you buy a note that's in default, you can buy that note, become the lender, foreclose, and then own the property at a significant discount. Again, something I wouldn't recommend doing on, little Miss Johnson down the street who's losing her house. But, there's somebody that has a 10 unit, it's in default. Something's going to happen with that place. Why not you be the one to take it over and bring the property back? So there's a bunch of different things. We're late, we're past 8:30, so I don't want to elaborate too much. I want to give you a couple nuggets, why I think multifamily is a good investment, number one. Number two, you have to invest and analyze your investments. Don't just rush in. Be very diligent on what you're doing, why you're doing it. It has to make sense. It has to make cash flow. It's got to make you money. Be aware of the risk that you're taking. And then how to find deals. Making sure that you're looking at properties. It may take a long time, but that's what I want to kind of talk. Now, a couple questions. Andreas, you had a question.
investors, or you find particular properties and then find investors?
Yeah, great question. So in our company at Infinity Investments primarily works as a brokerage, but we also work to go out and acquire property. And so we've done it where we've had a group of people together, 2 or 3, looking to go out and buy property, and we'll go find something. We've also had it to where we'll go out and identify a property and then bring in investors. That's a lot more difficult, raising the money while you're in escrow. But sometimes, if you find a good deal, you don't want to miss out on it. So you gotta make a move on it. But it's also a good thing to do if you can identify 2 or 3 people. Hey, you got some money, I got some money, I got some credit. Let's get together. This is what we're looking for. That's a little bit difficult to organize, but if you can do it, that's a better way to go out and try to buy property. So the biggest thing is if you're selling, make sure you're buying something better. And that was a lot of people who lost, like I was in 2007, 2008, when they sold properties, did exchanges, didn't buy anything better, and they end up buying something worse, unfortunately. So there's a time to exchange. There's maybe not a time to exchange. There's time to hold on to what you got. Maybe, time to, cash out, time to go and buy everything up. So market timing is another. Maybe we'll do a seminar one day on market timing, which is something that you can't really, it's not as concrete as analyzing income and expense, but it is something that you can kind of be aware of. Look, if we see prices shoot up another 50 to 100% from where they are right now, we might want to say, wait a minute, we might want to slow down a little bit, right? Because at that point, the properties aren't going to cash flow. So if it doesn't cash flow, don't buy it. If you don't want to buy income property that don't make income. Right. But in San Francisco, people pay some crazy price. San Francisco is a different animal. But it's San Francisco. So anyway, yeah. So, but a lot of people have cash, and it's a good place to put your money if you have cash. So I want to thank everybody for coming out. I really appreciate it, and I hope you learned something. Thanks a lot, and have a great night.